Welcome to Investment Banking University, where we teach you front office investment banking. We're going to be talking about the front office investment banking process that we teach here at Investment Banking University, and that's at investmentbankingu.com. So we're first going to start out with the table of contents. So we're going to be talking about, at a high level, the front office investment banking process. And you can see here from the rest of the table of contents, that is the process in order, starting with coverage, mandate target matching, origination, fee structure, and winning the mandate, underwriting, packaging, buyer list process, deal structuring, and the M&A process. So we're going to start out with front office investment banking first. In order to build a career in investment banking, it's essential for the individual to know and practice the front office investment banking process. And this is particularly important even at lower levels as an analyst or an associate, because this is really what you're building towards. So if you can gather some experience in the lower middle market or middle market on your own before even going into investment banking, at a bulge bracket or mid-market investment bank, you're going to have a leg up because you're going to see the big picture. You're going to have to, be able to talk about deal experience. And that's one of the methodologies that we're going to be talking about at Investment Banking University, taught at investmentbankingu.com. So whether one's career track is in a bulge bracket investment bank, mid-market M&A group, or a little more lower middle market M&A advisor group, it's going to be crucial for you to know this primary process as an investment banker. And that's going to be starting out once again with coverage, mandate target matching, origination, fee structuring and winning the mandate, underwriting, packaging, buyer list process, deal structuring, and the M&A process. And there's going to be a flow here starting from the beginning to the end of an actual sourcing and then actually executing and closing a deal. So in terms of coverage, the investment banker first has to decide what size of companies to cover, if this is going to be public companies, mid-market, lower middle market, and then from there, understanding the different verticals that you're going to be actually covering. So usually that's derived from one's own functional experience that they've had in their past, and then geography can also play a factor in consideration when choosing coverage. If you're going to be doing regional coverage, maybe state level coverage, just depends on how granular you want to get. And after you're choosing your coverage, the investment banker then builds an index for each of the different verticals and sub-verticals made up with public companies. We're going to be using and tracking this index and the changes in the indices in order to provide a measuring stick within which to evaluate targets against. So what we're going to be monitoring is a few metrics are going to be growth rates, margins, and multiples. So we'll be able to track that in real time and be able to advise on the strategic options for different companies based upon some of the changes there. And we'll talk about a lot of that in greater detail later on. So the investment banker takes the index and establishes tiers and turns those into peer groups. And this is why we pull comps in order to build an index and benchmark against those comps, kind of like we were just talking about. The indexing and benchmarking that is done for a target company serves as a basis for advising on strategic alternatives. So one should build these indices at a vertical level, and then sub-vertical level, and then finally at the sub-vertical level by a product. Now we get into mandate target matching. So now that we've actually established our coverage, understanding the size of the company that we're going to be focusing on, as well as the different verticals, we can then go about building relationships on the buy side. And this is going to be what's associated with the mandate target matching. And basically what that means is we're going to take the buy side's investment mandates and then match those with target companies within our coverage. And that's why we call it mandate target matching. After determining one's coverage, initiating coverage in the form of index building, building relationships with strategic and financial buyers in a given vertical, it's important to then begin matching the investment mandates of the strategic and financial buyers to targets within one there's coverage area. So that's once again mandate target matching. Once we do that, we can then go about the origination process. This is where we reach out to individual targets in their ownership or their management teams to understand kind of where they're at in their business cycle. And so M&A origination requires coverage, relationship building, and pitching. You first need to establish your coverage in a given industry, as we talked about. From there, we go about building relationships. And then from there, we can actually take the time to reach out, pitch them on their strategic alternatives, including selling their company. And then throughout the relationship building process, there's going to be different meetings that we have to go through. But basically what happens is we're taking these investment mandates from the financial buyers and strategic buyers, reaching out to targets, seeing where they're at, seeing if they're willing to entertain an offer on their company, and see if that's going to be a fit for what they're looking to do. In terms of fee structuring and winning the mandate, this can come in the form of a couple different ways. If we're reaching out on a sell side opportunity, meaning we're trying to originate a deal to have a company be sold, we're going to have a different approach than if we are on the buy side working with a financial or a strategic buyer and being paid the fee. Now, it's possible to gain fees on both sides, but realistically speaking, as you get to larger and larger deals. Now, if we're dealing in the lower middle market, perfectly fine to take a fee on both sides. As you go up and larger in the middle market and higher, it's going to be less, apt to do so. So in order to get paid, investment bankers have to land the engagement. Once the fee is agreed upon, the investment banker puts in writing the fee in something that's called an engagement letter. In the lower middle market to middle market, most investment bankers work on a success fee basis, meaning that they only receive compensation when a deal actually goes through and closes. So this is going to be important. And I've included a couple of deal structures here for lower middle market. If you're looking to get your feet wet, get some deal experience, be able to make the case for yourself better to an investment bank because you have deal experience and you've done the process and you know what you're doing at a high level. We're looking at 6% fee for companies that have total enterprise value south of 5 million, and then it just kind of goes down from there as you are getting larger, larger companies in terms of total enterprise value. It's important for the investment banker to have a strong understanding of fees so that you can discuss fees in a reasonable manner. One of the things that I would say is, making it a priority to get a deal done as opposed to trying to be a hard negotiator on the fee structure, at least at first. Getting your first couple of deals to close, even if it's a lesser fee, can be really helpful to build your confidence, build your understanding, build your track record. So, just keep in mind, a lot of these fees are flexible here. Be reasonable. Obviously, they don't, everyone wants to get paid and have an incentive to close deals. And as you move higher than $2 million in EBITDA, the Lehman scale appears, and this is the preferred method for pricing the fee. And we can talk about that a little bit later as we get into greater detail on fee structuring. So now that we have actually won the engagement, whether it's a buy side or sell side engagement, we're going to go about when we're actually looking at our options from a buy side perspective, or if we're doing a sell side process, we're going to go about underwriting the actual opportunity. So once the M&A mandate is won, it's important to underwrite the financial product in an M&A capacity by building a financial statement model and valuation. And then we're going to underwrite the financial product. One needs to gather historical financials. So this typically is trailing 3 years at a minimum and ideally lasts 5 years. After receiving the financials for the target, the investment banker must calculate adjusted EBITDA. Total owner's benefits may come into play for lower level deals if you're dealing with the lower middle market or SMB market. And they're proxies for cash flow, but not true cash flow of the business, as there will be CapEx and working capital deducted to get to true cash flow. Once we have historical financials, we can then build out the financial statement model, which will be the basis for modeling various scenarios, ultimately driving valuation. After arriving at adjusted EBITDA, the investment banker will determine public comps and extrapolate a multiple for the target company, adjusting for the size of the company. From there, precedent transactions will be spread to determine a mean multiple. Finding the midpoint of the valuation methodologies in the football field is what we call it, can be used for determining a valuation, but the range is often communicated to the client or potential buyers from just having a discussion. After building out the financial statement model, we can then build the transaction-specific model related to particular buyers, that have expressed or may potentially be interested in. So if we're dealing with a strategic buyer, for example, we're going to want to include synergies in our model to understand how that's going to affect valuation and pricing. Now, in terms of actually packaging the deal, we have to, after underwriting, we're going to then package the financial product in the form of various marketing materials that we're going to be distributing. The first thing is going to be a teaser. So the teaser talks about high-level stuff, doesn't go into too much specifics like the confidential information memorandum or CIM. So after finding adjusted EBITDA and determining valuation, the investment banker can build out the marketing material for the target company, which includes a teaser and a CIM. And this is assuming that's a sell side mandate. Obviously, when we're selling a company, this is the stuff that we're actively marketing. It's going to be a little bit different if we're going to be on the buy side and we're going to be looking at some, marketing material based upon the selling process. So the teaser is a summary of the client's key selling points. After creating the teaser, the investment banker is going to go into greater detail in a marketing document, as we mentioned before, and this is going to be associated with the sell side process. Now, when we're actually going through the process in terms of the sell side mandate, we're going to be building out a buyer list. So after landing the M&A engagement, the investment banker will need to build a buyer list and then begin outreach to the buyer list. In order to build the buyer list, the investment banker is going to use a database service to pull a likely strategic and financial buyers. But you should have a pretty good idea, since you're doing the coverage and building out the relationships, to understand who the major players are from a strategic and financial perspective within the vertical and sub-vertical. So you can kind of get an idea of a targeted outreach rather than trying to do just a big massive outreach or a blast. After finalizing the buyer list, we're then going to be contacting each prospective buyer in the list, and then contact should be to the corporate M&A representative for large corporations or CEOs and owners for lower middle market or middle market companies, and CFOs as well. In terms of actually structuring the deal, when we're having a conversation in matching a financial or strategic buyer's mandate with the target and landing the M&A engagement, et cetera, we're then going to work with the buyer and the seller to actually structure the deal. Now, structuring the deal usually involves having a conversation about a range of valuation to make sure that both parties are in the sphere of reasonability. Reasonable deals are what it looks like here. This is just some data that I have from my experience dealing in the lower middle market and in working on different deals that are, if you're dealing with a company that's an SMB and you're talking about EBITDA south of $1 million, you're looking at smaller multiples, like 3 or 4 times. As you get closer to $1 million in EBITDA, you get to kind of a metric of the 5 times multiple. And then as you go up, it just, the multiple increases, obviously, because we're talking about bigger and bigger companies or bigger and bigger financial perpetuities that have more demand for them at higher levels of EBITDA because there are just less companies. So naturally, the EBITDA is going to be higher there. In terms of some other sorts of categories for deal structuring, we're going to be talking about an asset sale versus a stock sale, cash versus stock versus cash and stock. And then is it going to be a majority or a minority ownership deal? And then also something that's going to be important is to understand whether the owner plans to stay in place as the CEO after the transaction, or whether there is existing management in place. Additionally, owner financing and earnouts are going to be a topic of a conversation that we're going to have later down in the greater course for the investment banking university that you can register for. Now that we've gone and actually reached out to buyers and we're facilitating the M&A process, the next thing that's going to happen is when we gain interest from an actual buyer, that gives us an indication of interest or an IOI. And basically this tells us after reviewing the teaser and summary financials, the buyer will notify you that they're interested in purchasing the company at a high level. This usually takes place after you've had just a conversation with them as to a reasonable range for a multiple. And after the IOI from the buyer, we're going to facilitate a buyer-seller meeting. And submitting the IOI, you're going to actually arrange an in-person meeting or a phone meeting if it's unavailable, or there's distance or timing or other issues related to that. From there, we're going to get a purchase agreement that's given to the seller after the buyer-seller meeting. You prompt the buyer to submit a purchase agreement and then give the purchase agreement to the seller. Then we're going to have a signed purchase agreement with different terms. The seller and their team is going to be able to mark up the purchase agreement and will either sign it, the agreement then, or counter with different terms. They are to sign the contract with contingencies written into the contract. Continuing along the M&A process, as we've done so and we get a purchase order that's been marked up with some different changes or accepted, we're going to enter due diligence. And then after receiving the counter, the buyer can sign the agreement with that makes it a legally binding purchase agreement contingent to the items that will now be explored during the due diligence period. As items are explored, the buyer signs off that the items are no longer in question one by one. So now we're moving to complete due diligence. After all the items in due diligence list are completed, due diligence is now completed and the closing can be scheduled. The documents are sent to the closing agent with instructions as to the M&A fee as well. And one of the important things in terms of M&A advisors and investment bankers getting paid is being in the flow of funds document. So closing inflow and funds, what are we talking about there? After the buyer and seller sign at the closing, the checks are cut and you receive the M&A fee and bring it back to your bank or have it wired to your account. So make sure that your firm is on the flow of funds document to ensure that you get paid. So this has been talking about the front office investment banking process that we teach at Investment Banking U. You can register for the course, which is going to go into greater detail on each one of the steps, and then we're going to work together to make sure you get the experience that you need. Most likely starting out in the lower middle market to middle market, so then you can obviously build your career in investment banking, whether that's working at a bulge bracket investment bank, mid-market, owning your own firm, working part-time, whatever your career goals are, this is to get you to that. So thanks for tuning in. Talk soon.